What's up everyone, it's Scotty with Money Investing. In this video we are going to be talking a little bit more about market breadth, and I've got 9 scenarios the markets can really take moving forward. Moving forward here, what are the different scenarios the markets can really take in the future. So I hope you guys enjoy this video and find it helpful. It's going to be a little bit different style. We're going to be kind of contemplating, I'll be sharing some of the probability outcomes, some of the things that I'm expecting from the markets here. So hope you guys enjoy it and find it helpful. Make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. If you're interested in joining us, there is a 16% annual discount available till the end of this month. So you'll get access to all the buy and sell alerts, options alerts, trade ideas, all the benefits, including all the private videos and private live streams as well. So I actually posted a video over the weekend talking about, markets back to all-time highs, ? This must happen, but it won't. So definitely check out if you haven't already. It's super informative, going over the numbers, specifically what is it going to take for the markets to actually be trading at an all-time high. So right now, S&P 500 needs to rally over 17%, and the NASDAQ, I think, needs to still rally over 25, close to 30% to get back up to all-time highs. So in that video, I drill down on this idea, on this question, on what it's going to take for the markets to be trading at an all-time high. So definitely do check that out if you haven't already. We go over the market weightings and, of course, the 7 big tech stocks that have really rallied in 2023 so far, which have resulted in the markets to push higher. Now, I've actually created a brand new chart. So this right here is going to be a brand new chart, which basically has about 45, close to 50 NASDAQ 100 companies, right? So NASDAQ 100 is, of course, mostly tech and market cap weighted index. And what you'll notice here is NVIDIA right now is one of the big leaders, up almost 100% year to date, followed by Meta, which is up over 87%. Then we've got Tesla up over 55%. Mercado Libre is up 55% as well. AMD is up 48%. Palo Alto Networks up 43%. Apple is up over 33%. Google's up 30%. Microsoft's up 29%. Amazon's up 28%. So obviously we've got some of the big tech, large cap names that are pushing higher. But then the other companies, such as we got Intuit, we got Pepsi, Intel, Starbucks. They're only up a modest 4 to 5%. They're not really technology companies, although Intel is, but Pepsi, Starbucks, these are more staple companies, right? They're still up 4 to 5%. And I think PayPal is another tech company I would consider fintech, which is down on the year. And then some other ones like Netflix and Lululemon, they are up 15, 16, 17%. So the bottom line is that technology obviously has had a huge impact on the overall market. Now, this is the NASDAQ 100. And what you'll notice is that there has been a little bit of a negative divergence forming, with the RSI making lower highs over here as the price continues to trade higher and kind of trade inside this rising wedge pattern as well. So from a technical standpoint, this is not a great setup because it is a bit of a rising wedge. At the same time, you've got that negative divergence forming. So, from an upside standpoint, it's going to start to feel very much limited as we start to lose some steam for technology as we progress here, because valuations are also going to become a bigger and bigger bigger question for the market as we progress here. Now, this is the NASDAQ index, the same exact chart, NASDAQ 100, with respect to the market breadth. So percentage of stocks that are trading above or below their 200-day simple moving average. And again, you've seen that breadth diverge. Fewer and fewer companies are participating with this entire market rally, and it's only been concentrated with just about a handful of stocks, 6 to 7 more specifically. But then, of course, we've got other technology companies within the NASDAQ that are also pushing higher, so we can really just club them together with the technology in general. This right here, the S&P 500, so at the top you can see that we're very close to our February highs, but we're not getting that same level of participation back when we were in February, right? February of 2023, back when the markets were once again trading at 4,200, there were more stocks participating in that rally, trading back above their 200-day moving average. And now we're seeing weaker breadth, in other words, fewer stocks participating in this move for the S&P to be trading back at the same level as it was back in February. This right here is the equal weighted index, the RSP. That's the S&P 500 equal weighted index. So every single stock is on the same level playing field. They're not treated differently because of their market cap, but instead they've got equal weight. And you'll notice that we're nowhere near close to our February highs. And not to mention, there's also a potential head and shoulders forming right now for this equal weighted index as well. Now, this right here are the 9 different scenarios. I believe it's 9 or might be 10 let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9. So 9 different scenarios the markets can basically go from here, right? Moving forward, these are the 9 different paths the market can really take. So what I have at the top is going to be technology, right? So technology sector as a whole, and more specifically, we're talking about some of the big tech companies, 7 to 8 companies that have really resulted in this market or kind of lifted their weight. And we're talking Apple, Amazon, Tesla, Nvidia, all those big tech companies. And then we've got X-Tech, right? Other sectors, other stocks excluding technology, the rest of the market, so to speak, right? Anything that's not tech. And then this right here is the activity, and this right here is the market and what that market reaction is going to look like. So I'm going to walk you through all these different scenarios, and I'll let you decide. I'll let you make that judgment call down in the comment section below what you think is the most likely path for the markets moving forward. I'll kind of share my opinion, my perspective. I'll really be thinking out loud. But the point is that I want to simplify it as much as I can so everyone can participate, understand what's really going on. So when we come down here, this is the current situation, right? Technology has rallied and other sectors have either stayed flat or they have maybe somewhat rallied a little bit, right? So that's really what we've seen from the market so far, because a lot of sectors, if you come over to this chart, which is a little bit more of a good representation, you'll notice that QQQs are up 22%, XLC, XLK, XLY. Those are your comm services, technology, and discretionary. They're the ones that are up a little bit over 22%, 23%, and all other sectors are either flat or slightly down. So starting with staples, up over 3%. We got, industrials up 64 basis points, less than 1%. Industrials, 6 basis points, right? Materials up 60 basis points. Real estate, flat. Silver, flat. Dollar index, flat. Utilities, slightly down. Healthcare, slightly down. So you get the idea. Technology is the one that's leading the way, and they're the ones that are actually pushing higher. Other sectors are either flat or down. So this is 2023 so far. This is the current state of the market, right? That's where we are. Technology rallying, other sectors either flat or slightly down. Now, these are the different scenarios that can happen moving forward as we go from, starting in May all the way through 2023, remainder of 2023. These are the different scenarios that can play out. Either tech continues to rally, right? We see more momentum to the upside, and other sectors also start picking up steam. We see new rallies in other sectors, right? Other stocks excluding tech. Now, that's going to be a broad-based rally. That's going to be a broad-based move to the upside. That's going to be more about new money entering the market, money that's sitting on the cash, on the sidelines, and money market accounts. That money is going to enter the market. It's going to start scooping up some shares of X-Tech, and technology is going to continue the rally. So we're going to see a more broad-based momentum and a lift to the market. And in this scenario only is when the market's up the most, right? We see a potential for markets to get back up to all-time highs. The other side of this coin obviously is that tech starts selling off and other sectors sell off even more. Even though they've been flat or slightly lower, they both start selling off at the same time. And this is also going to be broad-based, and this is the only scenario where the markets are down the most. Other scenarios are obviously a mixture of one or the other. It's a compromise. It's a more of a rotation and not really a broad-based move. So for example, if tech continues to rally, despite what we've already seen, if it continues to gain momentum, continues to rally, and other sectors accelerate their sell-off to the downside, what we're really seeing is a bit of a rotation again, because sell-off in other sectors means money is coming out of those sectors. It's going into tech because tech is rallying in this scenario. So in this example, the markets are going to be up a little bit, not a lot, because other sectors are selling off, tech is pushing higher. So on a net basis, markets are going to be higher because of the influence technology has on the overall index, right? Because of their higher weight, markets are going to be up a little bit. Now, if this was reversed, if tech started selling off and we saw other sectors started pushing higher, once again, we're not seeing a broad-based, or if anything, we're only seeing a rotation because people are taking profits out of technology and they're starting to put into other sectors of the market. And that's going to be resulting in a down a little bit market because, again, tech is selling off. Tech is what drives the market because of the influence it has. It's higher weighting. So in that scenario, I think the market's going to be down a little bit. This is where we are currently, so we don't have to go over that again. And if market technology stays flat, right, doesn't rally, doesn't start going down, but stays flat, and the other side of the coin, which is other sectors, other stocks, excluding tech, start rallying, well, this again is going to be a bit of a rotation. So we're seeing, money start to go into these other sectors. Not really more specifically rotation. I should really put down new money kind of chasing the other sectors, other stocks, including tech. And in that scenario, market's going to be up a little bit because again, if you do the math, if you logically think about it, technology is flat, other sectors are catching up, and that's why the markets are going to get a lift, not by a whole lot, but just by a little bit. And then of course we got 3 more scenarios where technology remains flat and the rest of the market starts selling off. This is just going to relate to new selling pressure coming in on other sides, other sectors of the market. And in this scenario, I think the markets are going to be down a little bit. And then if tech starts selling off and other parts of the market remain flat, then I think that's going to lead to some profit taking because we're not really seeing a rotation. In other words, we're not seeing people selling their technology shares to kind of put it into other sectors of the market, which is what we saw over here, like tech selling off and other sectors rallying, which was a rotation. But you'll notice a difference between that selling off and the other sector staying flat is profit taking because it's not going from tech to other sectors. In this scenario, I think the markets can be down a lot because again, technology is what really rules the market. It's influenced by the market cap. And if both sectors are obviously flat, if you don't see any movement whatsoever, obviously nothing happens and the market stays flat. So, considering where we are right now and what we know about inflation and interest rates and everything to do with macroeconomics and unemployment and recession fears, I think we can rule out the probability of a broad-based sell-off. I think this is something that we can potentially rule out unless we start to see a very, very severe recession in the economy. Unemployment for all of a sudden starts to shoot up over 8%, 10%, earnings start declining pretty dramatically, then I could see technology selling off pretty aggressively and then the rest of the market also following. So that is a bit of an anomaly, right? Low probable outcome if we see a very, very severe recession. Only then I think we can see a significant move to the downside for the market. Now, when it comes to both sectors rallying, I personally don't see that happening. And the reason for that is technology's already rallied so much. And again, in my previous video, I talked about this, right? I mean, Apple needs to go up so much. Amazon, Meta, Netflix, they all need to go up so much more. Where's that money going to come from, right? How big are these companies going to get before valuation comes into question? So I don't see that. Personally, I put that as a very low probable outcome as well. Now, that leaves us with a little bit of rotation, right? That leaves us with a little bit of compromise and not really seeing a broad-based move to the upside. So one possible sort of a scenario that I could see for the markets playing out right now is either tech starts to go flat here after this huge rally, the momentum starts to weaken. We don't really see a sell-off. We instead see the tech starting to go sideways and other sectors catching up. As inflation situation improves, as the economy, there's hopes for a soft landing, unemployment doesn't start to go up, and inflation starts improving and interest rates obviously stay where they are and they eventually start getting cut towards the end of this year. So this is a potential scenario where I could see the market moving forward, where technology starts to stay flat and other sectors start catching up on this brighter economic landscape, and that's going to lead to a little bit of rotation and the markets could start to drift upwards slowly and steadily, where we are up a little bit. Other scenarios, tech sell-off and other sectors staying flat, or tech selling off and other sectors starting to go up a little bit, like this scenario, for example, is also possible. But that would only be possible based on the valuation, right? I mean, nobody wants to, let's say, own Apple at $3 trillion market cap, right? Nobody wants to buy, let's say Nvidia at $800 billion market cap, right? So they could see that as a bit of a profit-taking situation, and they can start looking into some of the other sectors, right? This is all about market liquidity, right? Where is it going? Where is it going to go? Where is it coming from? That's what this analysis is all about, is we're trying to understand where the liquidity has been going to, which is tech for the most part, and where could it possibly go to next in the future, as we obviously see it rally between the markets for tech and for other stocks that are really just sideways and going down. So this scenario is possible also, but that would be more of a question about valuation and whether investors, institutional investors, hedge funds want to call their profits in, so they'll just be selling it off and then putting it into something else as the situation improves. Or it could also be based on a potential recession where staples become very, very attractive, utilities become very, very attractive, and as a result, interest rates are basically hurting technology stocks and valuations, and money comes out of there, goes into staples and utilities. So those are the two scenarios where I could see the markets really take, like the path where the markets could take, unless, of course, I mentioned that we see a pretty significant recession where both sectors or both parts of the market start selling off. That's going to be a more broad-based sell-off. But let me know your thoughts down in the comment section below, and where do you see us ending up on this matrix, moving forward? Where do you see the liquidity really going to? Do you see a broad-based rally? Do you see a broad-based sell-off? Or do you see a little bit in between? Let me know in the comment section down below. What do you think? As always, if you enjoyed this video, find it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. If you're just joining us for the first time, the link to our Discord and Patreon is going to be down below. As always, happy investing, and I'll see you all in the next video.